Hello and welcome to the first episode of Companies and Markets Weekly of 2025. Happy New Year. I'm joined today by Megan Boxall. Hello, Megan.
Hi, Happy New Year, everyone.
Happy New Year. I'm also joined today by Graham Neary. Hi, Graham.
Happy New Year.
Happy New Year to you too. We are pre-recording this. We're recording this on the 20th of December, 2024. So we're speaking to you from the distant past. But what that does mean, we are going to be talking about some specific stocks today. Megan and Graham are undoubtedly going to be talking specific bits of data like share prices and certain ratios. Obviously, bear in mind that these may have changed slightly since recorded. So all the data that we talk about was accurate at the time of recording. Hopefully it's not changed too much since then, but just bear that in mind. I'm going to talk a little bit to the panel about how they've gone about selecting stocks for their 2025 watch lists. And then we've picked a handful of them and we're going to dive a little deeper into some of the specific stocks that they are interested in. I believe that Stockopedia subscribers can get the full watch lists on the platform as well. Just before we get into that, brief disclaimer. Obviously, this is not financial advice. Stocks can go down as well as up. We also may well hold some of the stocks that we are talking about. Where we do, we are going to disclose that. We'll try to do so verbally, and if not, those disclosures will be available in the episode description. What's your general outlook for the year, Megan, Graham?
To be honest, quite cautiously optimistic. I have spent a little bit of time over the last couple of days sort of reviewing the year gone, and I think there are things like as we close off the year that there is worth finding optimism and positivity in. I do think it's a difficult time to be an investor. I think it's quite a difficult time to be a private investor in particular, especially a stock picker. I am finding it extremely difficult to make a fundamental valuation investment case based on the kind of logic and sound rationale that I have done in the past. But I am feeling relatively optimistic about the outlook for the markets as a whole. I think the US markets, I can't really see what's going to cause them to stumble in 2025. And I'm hopeful that in the UK there'll be a bit of a turnaround in sentiment there. I don't know, Graham, if you feel the same way. I don't know if it's just a bit of Christmas cheer that is creeping into my mindset.
Yeah, I think it's a good time to look at individual stocks because the Magnificent Seven, I think most of them by conventional standards are objectively overvalued now. That's not to say that they can't keep going up or that they might not outperform expectations, but the idea of just passively buying the Magnificent Seven, which is so heavy now in the market indexes, is not something that I would be too hot on. So I think it's a good time to pick stocks, especially in the UK with huge discrepancy against American valuations. Finding decent stocks here, I would say we can look forward to plenty more takeover bids in the new year, unless something changes.
Nice. We're going to come on to the specific stocks that you are thinking of picking in the next year in a second, but I wanted to drill down a little bit into both of your processes for finding stocks for your watch lists, adding them, and sort of picking the best candidates among them. Megan, do you want to start?
Yeah, I can do. So I think for me, I'm very much a long-term investor. I don't have as much time as I would like to do research for myself, research for my own personal portfolio. So partly it's a time thing, partly it's a money thing, partly it's an age thing. I'm 32, so I am very much an investor looking for long-term gains. It's also where I actually like to look for companies as well. I love quality companies. I love investing in companies in the US, and also the higher quality names in the UK. And you'll see with all three of my picks that we're going to talk about today are very high quality companies. So with that in mind, I have set up some screens to help me try and identify companies which fit that style of investing. So long-term compounding quality. I have a number of screens. I find that the screens that I've set up, they need to be tweaked slightly dependent on the market cap size and the geography that I'm looking in. So I have got a number of different screens. I also am very, very keen to to identify stocks in sectors or areas that I think there are still strong trends at play. And I do believe that AI continues to be a very, very strong trend that will continue to provide buoyancy in the market in 2025. So I've got a specific technology screen which aims to identify. It's called high quality, high performing tech stocks, and I've actually whittled it down to the UK. It's only got 3 companies that have come out of it, and one of them is one of my picks. My other screens have helped me identify the other 2 stocks I'll talk about today. So yeah, a mixture of my personal outlook, take on investing, and some screens to help me whittle down the names. And then I've done a little bit of research, had a look at the valuations, and I would say that all 3 of these stocks I'm going to talk about are on my watch list. I'm not buying them yet. I'm still thinking.
Graham, how about you?
So my process is pretty simple. I have the luxury of being able to study RNSs most days. Stockopedia members can see a spreadsheet that we maintain, which shows the views of all the writers on all the stocks we cover. So I simply go back and see which stocks I liked the best from that spreadsheet, and then I decide if any of them are worth joining the watch list in the new year. My default is to leave stocks on the watch list each year. So, if something was on the watch list last year, it will probably be on the watch list this year, unless something's changed, in my view, in which case it could be up for substitution. So that's my process. I tend to stick to sectors I feel I understand reasonably well. So as I've said in another podcast, I'm not very well diversified in terms of sector, but that's just because if I want to put something on my watch list, I want to feel like I understand it as well as possible.
It reminds me a little bit of a story I heard about, I think it was a professional investor who would keep a stack of Financial Times papers on his desk, and every day he would put that day's FT on top, but then pull out the bottom one from a year ago. And if the trends had stayed, like if something was talked about a year ago and was still talked about today, only then would he consider going and investing in it. So it reminds me of that a little bit. I have no idea where that story came from. I may be making it up. Who knows? Megan, what's your first cab off the rank in terms of the stocks that are on your watch list?
I'm going to start with Garmin because, as I say, I like US stocks. And I think as of right now, on the 20th of December 2024, this is one of the best. It is a really great company, and I am sad that I didn't buy at the start of this year because it's had a fantastic year. And I believe it can keep delivering.
So do you want to run through just very briefly, what does it do? How does it make its money? And what opportunity you see here?
Yeah, so Garmin is, probably best known, dependent on who you are, for being a specialist in GPS tracking. The actual device that you know it for, I guess, depends on who you are and what you have used it for. Garmin was very popular pre-Google Maps for being a navigational device for people's cars, and it still does have a sector that operates in the automotive industry, although that looks somewhat different now than it did when Garmin and TomTom were the leading navigation companies in the automotive sector. If you're more of an outdoorsy type, you probably know Garmin for its watches, its wearable devices. Wearable devices are far and away the biggest divisions. It splits them into two of its operating divisions. So one is outdoors and one is fitness wear, so smartwatches for tracking exercise. It also makes devices for your bike, so which you can clip onto your bike for navigating if you're cycling, and also if you're into golf. And one of my colleagues swears by his Garmin hole finder. I do play golf. I have never felt the need to use a Garmin to find the golf hole, but he swears by it, and he thinks it's changed his game. So yeah, lots of different operating subsidiaries, but all revolving around GPS.
Why? Okay. Are there any competitors that are sort of listed and investable? And if so, no?
I think the biggest competitor for Garmin is actually Apple. It's a funny comparable, because I think as a user you probably wouldn't think they are similar companies. I mean, most people use Apple for their phones and Macs and iPads. Obviously, it does have the watch division as well. Garmin is more the wearable devices and the GPS navigation, but they're both computer companies. They're both tech companies, and they operate in a very similar way. Garmin more on the hardware side. Apple is shifting more and more into the software side of things, and obviously now its services division is a key element of the growth story at Apple. Whereas Garmin makes hardware rather than software, so services are a smaller part. It does have an app. The Garmin app is fantastic. It's a very, very good app, but it's a free app. And so yeah, I would say that they are quite a similar profile. I think looking at Apple, if you're more familiar with the Apple investment case, I'd say investors maybe look at Garmin in a similar way. They're trading on very similar multiples at the moment as well.
What you said at the top of the episode, that you're not looking to buy anything on your watch list just yet.
Well, that's mainly because I feel like I need to do a little bit more research. By the time you're listening to this, I may have done it, but if that is the case, you'll know, because it will be in the show notes. But as of the 20th of December, I'm not a holder. The reason I'm a little bit hesitant about Garmin right this second is mainly because of that momentum and that share price trajectory from the last year. So shares are up 62% in the year to date at the time of recording, so in 2024. So it's had a really, really great year, justified somewhat by the fact that earnings, it's far exceeded all of the quarterly earnings it's reported in 2024. And as such, the earnings expectations for the year have been increasing. And that's a key thing that we've seen in a lot of the research we've done around identifying multi-baggers, shares that multiply in value. And that's stocks that the earnings expectations keep getting higher and higher. So if Garmin can keep achieving that, I have no doubt that share price trajectory will continue. The thing that makes me a little bit hesitant about whether or not that can continue is what happens, what could happen to the US market in particular from a factor perspective in 2025. Momentum has been a real factor driver in the markets in 2024. And it's quite rare for momentum to be the factor that drives markets in consecutive years. And I think if momentum does start to stall a little bit, companies that do have quite lofty valuations, which have had very, very good 2024s may not be able to keep up the pace unless their fundamentals, unless their earnings can. Garmin revenue is growing strongly, especially in its three smaller divisions, which are marine, automotive, and aviation. The fitness and outdoor sections are growing at a slightly lesser rate, but aviation, marine, and auto are high, aviation, marine in particular, are high margin parts of the business, especially at the gross level. So I am optimistic about the outlook for Garmin in 2025, but yeah, it's just that valuation which concerns me a little bit at the time of recording.
Interesting stuff. I'm going to make sure that we link to all of the stock reports on Stockopedia for all of the stocks we're talking about today. So if you want to go and check those valuation metrics out for yourself, you can do so using the link in the show notes. Graham, what's your first pick?
Thanks, Lawrence. My first pick is CMC Markets with the ticker CMCX. The market cap here is £700 million or so. This stock was on my 2024 watch list, and I'm leaning towards keeping it on the watch list for 2025. It has produced a total return of something like 150% so far in 2024. But I think even after generating that return, I think I can still make a case for it. So I am a long-term shareholder in IG Group, which is a competitor to CMC. I'm also someone who's followed Plus 500 in a lot of detail over the years. So I like these sort of CFD, Forex, spread betting companies because they tend to be very profitable, but the risk you take with them is you take regulatory risk for one thing, and the industry is much more regulated now than it was before. You also take the risk of demand and trading activity falling away, which happens from time to time, and it's not easy to predict trading activity. One thing that you can sort of watch is the volatility index, or the VIX, because in periods of high volatility, you tend to get high levels of trading. But apart from that, there's really not much you can do. Now, in terms of CMC itself, probably the first fact that you need to be aware of is Lord Cruddas being a 59 or 60% shareholder, and he remains in charge here. So we've got a very, very well-aligned sort of founder figure as the CEO. And in terms of the outlook, where we're going from here, I had an interesting back and forth in the comments section of our daily report back in November. If I try to summarize what's happened, essentially, it looks as if CMC makes very little effort to get the city to accurately estimate its results. And it's not CMC's fault. It's just, I guess, it is CMC's fault in the sense that they don't help the analysts to get the forecasts more accurate. But it's not a crime, and it doesn't really hurt anybody, except people can get a bit confused about what CMC is actually going to earn. So, for example, in H1 this year, CMC generated nearly £180 million of net operating income. And that's more than half, well over half of the full year forecast. So when CMC released its interim results, it said they were in line with expectations. And as a result, people are thinking, well, H2 must be pretty bad then. And the shares have come off quite a bit since that statement. However, if you look at what happened in the previous financial year, CMC was very, very slow to upgrade its forecasts, and even with just a couple of months left, they put out a range that was well below what they eventually earned. So I'm not saying that CMC are definitely going to beat their forecasts. I just think the forecasts aren't really worth much, and it's worth looking at this company, forgetting the forecasts almost. But it looks to me as if it's still trading on a nice PE multiple, no matter what forecast you use. It's not looking overly expensive, maybe 11 times earnings or something like that, generating very high returns, and probably, well, I can't really say that we will probably have a volatile year next year, but the VIX has been more elevated after the recent Federal Reserve decisions and announcements. So there could be a pickup in volatility, which will give CMC a boost towards the end of the financial year, which ends in March. Yeah, I'm still a fan of this company. I still think the valuation is reasonable. And they have a very exciting deal with Revolut, where they provide back-end trading infrastructure to Revolut. So it's not just B2C, it's B2B as well. Their technology is so good they can effectively license it to other successful companies. So yeah, I think there's a lot to like here.
You said earlier you were a long-time holder of IG, and you've also followed Plus 500. Obviously, two companies within very much the same sphere as CMC Markets. What's your reason? Is it that what you've just said? Is that your main reason for putting CMC on your watch list, or do you think why do you think that CMC is the better opportunity out of those three currently? Obviously, notwithstanding the fact that you hold IG.
Yeah, I mean, I hold IG because I've always held IG effectively. IG is bigger. The difference with IG, I guess, is that its results are a little bit less volatile because it's so much bigger. In the case of CMC, its profits can effectively disappear if trading is extremely light. So if people aren't trading, CMC's profits go to zero, and that is what created the enormous opportunity in CMC shares a year ago. Because when you have this sort of operational leverage with a lot of fixed costs and with revenue that goes up and down, it's a risk and it's an opportunity. So I think CMC still has this opportunity to produce a higher rate of profit growth. So in that sense, it's a little bit riskier, but I guess I like the risk reward. In the case of Plus 500, it's sort of in its own category. It's an international company, but I sort of consider it to be a foreign operator. There's a few very specific issues with Plus 500, but yeah, CMC is my preferred pick.
And obviously, as you said earlier, with companies like this, a lot of the revenue is very dependent at the moment on volatility and sort of the amount of trading that's going on, there might well be an argument to make that years like 2024 are kind of as good as it gets for companies like this, with the VIX spiking massively sort of mid-year. Does the deal with Revolut help offset some of that risk, or is it all still tied in?
Yeah, I mean, I would like to get like detailed numbers on what the Revolut deal is worth, but it's not the only deal that CMC has. They're active in New Zealand. There's various other companies that have or will use CMC's infrastructure. So that's something that kind of, I would say, reduces the risk to some extent, because it's just it should be fairly high margin work. But yeah, there's no getting away from the fact that if we have a very quiet year, CMC's results are going to suffer. No question about that.
And what about its balance sheet? It apparently has net cash, but do you think it's doing enough with that cash?
Yeah, I mean, I'm comfortable with that. I think the balance sheet is worth £400 million from memory, and so that was something that initially attracted me to the share. Was I noticed that it was trading well below that, so it's got a very liquid, very rich balance sheet, which it should have, because of what it does. It pays a modest dividend, so yeah, I've got no concerns there.
We will wrap up CMCX there. Megan, we're going to come on to your second stock. Which one are you picking?
Talk about Relx next, staying on the large cap side of things for now. Relx is a stock that I have talked about quite a lot before. I like it a lot. I think it's a really great company. This is the company that emerged as one of the three in my high quality, high performing UK tech stocks. The other two were actually one that Graham is going to come on to talk about, and the final one was Rightmove, which has been a takeover target this year, which has potentially explained some of its outperformance. Relx is a FTSE 100 company. It operates across 4 divisions, probably best known from a consumer perspective for its medical and scientific journals, like the Lancet, one of the biggest scientific journals which it owns, and also its legal data and support. Its content business, I guess. But the most exciting division, sorry, not the most exciting division, but as an investor, maybe the most exciting division as a consumer is its events business. It owns Comic-Con. So that's when I used to work at the Investors Chronicle, the picture that we always used to use was a picture of Comic-Con. But yeah, the most exciting division as a investor is the risk business. So the risk business is where the company, it provides data analytics to businesses and governments. It has a lot of very, very sticky customers. And they found, the company has said in the last few years, that demand for financial crime and fraud investigations, and also just the shifting dynamics of the insurance market, have provided a huge boost to that risk business, which is growing very, very quickly. It's also the division with the widest operating margins, and it's the division which has the most exposure to AI. So that is why I think, despite another fantastic year for Relx, I believe it will continue to do well in 2025.
Seems like a fun combination to be fighting cybercrime and fantasy crime all at once.
Yeah.
So sounds like a relatively complex business, making money from lots of different divisions.
To be honest, I don't think it's actually that complicated. I think it is a very under the radar business, considering I'm pretty sure it's one of the top 10 largest companies in the UK at the moment. It certainly has been a number of times. And it doesn't tend to get an awful lot of coverage compared to, say, the big banks or the big pharmaceutical companies. It tends to fly under the radar because it doesn't really do an awful lot of consumer facing things. Most of what it does is business to business. It's we talked in a podcast earlier, at the end of last year, about nice reporting. Relx sets out its financial results very, very clearly. Its chief executive, its management, its chief financial officer more than its chief executive actually, is always on the end of the phone, which is something that I find extremely impressive about some of these bigger companies. As a journalist, it's especially as a journalist for smaller publications, it's often very hard to access management for FTSE 100 companies. But I've met the senior executives at Relx on a number of occasions. They're brilliant. They always are available to answer questions. One of the things that tends to crop up with Relx is it does have quite high gearing. It has a relatively high debt position, and that gearing tends to be hiked up at the start of the year. So when it announces its annual results, and that's because it pays the bigger chunk of its dividend in the second half of the year. So in the first 6 months of 2025, we'll see that gearing figure be slightly higher than it will be in the second 6 months of the year. And it's a query that tends to crop up every year. And Nick Luff, who's the chief financial officer, is always willing to answer the question about why we shouldn't be worried about gearing. I think gearing has been could have been more of a concern while interest rates have been higher. But as interest rates continue to come down, gearing should become less of a problem for Relx. But yeah, so I'd say probably relatively challenging to get your head around all the different operating subsidiaries. But as a business, it's not too complicated. It's a revenue, high margins at the gross level, very high margins at the operating level. They tend to average around 25%. A high quality, highly cash generative, dividend paying company. Lots of ticks.
Yeah, what's not to love? When you've been researching this, is there anything you want to do more research on? Any questions for you that are still left unanswered about Relx that you want to dig into?
Yeah, so I think one of the things is that exposure to AI and whether or not it's going to be disruptive to companies like Relx before it is productive. I think companies which are paying subscriptions to Relx, so for its scientific journals and for its legal content as well, there could be a potential disruption to those businesses as we have more large language models, as data becomes easier to get hold of, as information becomes easier to get hold of. But I think in the long term, there's almost no doubt about the way Relx is positioned, that it will be a beneficiary from the move to AI. Large language models and a lot of other applications of AI benefit or rely, on data centers. And Relx owns huge volumes of data because of the nature of its business. It manages risk for big organizations, including governments, and owning that data and running those databases puts it in a very, very strong position when it comes to teaching large language models and other applications of AI, because it owns hugely high quality data. So I think that is a very exciting potential upside for Relx. But why I would like to do a little bit more research from this point is how long it will take for the company to really benefit from that trend. I think companies like Nvidia and Broadcom and the semiconductors and the hardware and software companies, they're clearly very, very instant beneficiaries of AI because we need them to start getting the AI stuff up and running. But I think potentially companies like Relx could be later on beneficiaries. So whether or not the timing is quite right at this level, I'm not sure. It's had a good year, just like Garmin. The shares are up 19% in the year to date in 2024. Obviously not quite as spectacular as Garmin, but when you think about where the UK markets have gone in that time compared to the US markets, it's probably quite comparable. So yeah, whether that can continue next year, I think will be a little bit dependent on that continued growth from the new AI space. The one other slight question that I have about it is if there are other companies that are similarly placed to benefit. There's a Dutch company called Wolters Kluwer. I'm sure Dutch people would pronounce it better, which is a similar business. It's a little bit smaller, so it's growing a little bit faster. And I wonder if maybe that might be a better opportunity for right now. But both companies benefit from the same extremely high barriers to entry because of these data centers. So yeah, I like them both a lot.
Nice. And yeah, I'm sure we will get messages correcting our pronunciation of Walter's Clover. No idea. Your guess is as good as mine. Graham, what's next on your list?
Yeah, so I think next I would mention Polar Capital with the ticker POLR, market cap as I speak of about £520 million. This is another company from last year's Watchlist, which I am inclined to actually, no, it was a new entrant this year in 2024, and I'm inclined to leave it for the 2025 list. So this will be its second year on the watch list. And the reason I'm highlighting this one is it's pretty much the only fund manager that has been enjoying inflows. So the entire fund management industry has been suffering. And if you look at Polar and its quoted peers, I'm not sure, maybe you'll find one other company with an inflow, but they're pretty much all suffering outflows. I think Polar's success is down to the fact that it focused on technology, which did extremely well. It branched out to healthcare, which did extremely well. And it has continued to diversify. It has a big insurance section as well. And the really big winner over H1 of this year has been emerging markets and Asia, where it has enjoyed inflows of £900 million in 6 months. So a huge result for Polar there. Total AUM is £23 billion. So that was a big win over 6 months to get 900 million of inflows into their Asia funds, and it looks as if basically people have been switching from competitors into Polar. That's the explanation that Polar's given, and it makes perfect sense because the industry as a whole has not been enjoying inflows. So if you are getting inflows, there's a good chance you're actually just getting money that's come from another fund manager. So Polar's AUM, as I say, it's continued rising. They've given a number of 24 billion actually for November 2024, early November. I'm sure there'll be another update soon. But these shares trade at about 10 times earnings or so. If you check the valuation relative to assets under management, it is admittedly a lot more expensive than other fund managers. But I would say that's probably justified because investors are still pouring money into Polar, and Polar has a great reputation in technology, healthcare, insurance, And I suppose there is a risk as it continues to branch out that this niche that it built could be diluted. On the other hand, there is a chance that it just becomes, a very prestigious name in fund management, and that and that its competitors sort of continue to struggle. If I was to point out a risk, I mean, 42% of AUM is in technology. If you look at its top holdings, so for example, the Global Technology Fund with £5.5 billion of AUM. Just checking its top holdings there, the very top holding that fund has is Nvidia, which is 9% of the fund. And if you scroll down there, you've got Microsoft, Alphabet, Meta, which is Facebook. So if you do think that these leaders are about to fall off a cliff, I guess that's a risk factor. But I would say that personally, I'm willing to look past that. In terms of its capacity, it says that its existing funds could manage up to £64 billion from the current level. So they think they could manage far more than they currently do with their existing fund platform. They've recently launched a small companies fund, which I think is interesting. So yeah, I'm happy to stay positive on this one. I only put it on the watch list for the first time in 2024. It has generated a positive return so far this year, and I'm inclined to give it another chance for 2025.
Great. I'm assuming a lot of its funds are actively managed. So do you see any sort of key person risk? Like, are there any fund managers there who've done really well recently, who might be at risk of leaving?
Yeah, they are actively managed. Just looking at some of their biggest funds, they have an active share of about 60 to 70%. So that's a very good active share in my opinion. I suppose it could be bigger, but that's a proper active fund. In terms of star fund managers, I'm not really aware of any major risk on that front, but I'd be open to information there. But as far as I know, they've got they've got a whole bunch of autonomous teams, semi-autonomous teams. They work independently under a common structure, and I think the name of the company is really valuable now. It's got a valuable brand name in Polar Capital, and that's where I see the value.
Finally, as a DIY investor or a private investor, I guess there is a choice between buying Polar Capital's funds that are listed. So there's the Tech Trust, Global Healthcare. What's your thesis behind owning the parent company rather than investing into the funds themselves?
Yeah, so I mean that's a great question, Lawrence, and I've been I've actually been thinking about that a little bit recently. That a lot of private investors will just buy a fund, but then when you go a little step further and you want to research individual names, then you have the opportunity to buy the companies that manage the funds. And the opportunity there is you get the potential for compounding wealth. You are earning effectively the fees that other investors are paying, and you are earning these management charges. So in a perfect world, you buy a fund management company and it benefits from inflows, it benefits from rising stock markets, all of these things growing management fees over time in a compounded way. And The other great benefit of fund management companies, as I alluded to, is that once they build their platform, all the growth just gets thrown on top with additional fees without much additional cost. So that's the beauty of a successful fund manager, is it can just keep growing its assets, growing its fees, and its costs should not have to rise very much once it's built the platform. So in the case of Polar, 64 billion pounds of capacity is what they claim. The downside, of course, is that inflows aren't guaranteed. Funds can underperform. The trend for different types of fund and different types of investing can change. And some fund management companies have been very poor investments. So there is that bit of work required to say, well, are these guys good at what they do? Are the trends in their favor? What I always do with fund management companies is I look for companies that have a niche, that have a good brand name, and that do something ideally that a private investor would be unable to replicate. So you could argue that this technology fund, for example, could be replicated. You could just buy Microsoft and Nvidia and Apple and so on. But I suppose that's the challenge, is saying, well, I think the technology trust will remain attractive. The Polar Capital's funds do have a good long-term performance track record. They generally are in the first or second quartile over the long run or since inception. More recently, their funds haven't been doing quite so well over the last 3 years, say. But I suppose this is the challenge. And but I think a successful fund manager should outperform its funds, definitely.
I also assume there's a nice dividend being paid.
Yeah, so Polar is paying a chunky dividend. I don't know. I wouldn't invest in it for the dividend because it's so big that you'd wonder. You can't invest on a 9% yield and presume that you're going to get that forever. So I wouldn't invest in Polar for the dividend, but yes, they do have a track record of paying out to shareholders.
Excellent. Megan, what's your final pick for your watch list?
My final pick is Tristel. I must admit that I actually I followed Graham's way of finding this stock rather than my aim to be slightly more systematic and use screens. I was looking at Tristel ahead of its AGM, which was the week just before Christmas. And it's a stock that I have been interested in for a very long time. It's a stock that I followed for a very long time. It's a stock which every single year disappoints for exactly the same reason. And I am interested in it this year because 2025 might finally be the year that Tristel cracks the US. Because it has failed to do so again in 2024. So that is why it's stumbled onto my watch list because I was interested in it ahead of its AGM, and now I'm going to look at it a little bit more because it's actually got a new chief executive, and I'm not suggesting in any way that it was the old chief executive's fault that Tristel never quite managed to get its products flying in the US. The old chief executive was actually the founder, and he was very, very good. Apart from the fact that he was taking quite a lot of money out, which always seemed to surprise me. He owned, obviously he was the founder, he owned huge chunks of it, and every year he was selling down, where his money would probably have been worth quite a lot more if he had just held on. But anyway, new chief executive, he's called Matt Sassoni. He's very good. He has experience in the US. He has experience in small mid-cap pharma, and potentially he's going to be the one who helps get the company selling its products properly in America.
So what does Tristel sell?
So Tristel is it is a hospital disinfectant company. So it has proprietary technology, I suppose, based on chlorine hydroxide solution, which is prior to Tristel founding, hospital implements were disinfected using disinfectants that were actually toxic. And then Tristel came along with its chlorine hydroxide and revolutionized the hospital equipment disinfectant market in the UK. It's now the gold standard for hospital disinfectant. It's surface wipes and cleaning products for implements like I don't know, implements that use in hospitals, scalpels, I guess. I'm not sure. All sorts of different equipment that's used in hospital, ultrasound equipment, urology equipment, stuff like that. And stuff that obviously needs cleaning very, very, very thoroughly. In the UK, the market has, I suppose, been easier to saturate than in other geographies because of the NHS. We have got one healthcare supplier. It doesn't mean that in the UK there's literally one customer for Tristel, and this was something that I found very, very interesting when I spoke to the company during COVID. They said, or the chief executive at the time said, that he was really shocked that individual hospital trusts were competing for supply, because supply was obviously constrained during the pandemic. And he said that they were finding that a hospital trust was ringing up and being like, we need £1 million more, and they'd have to be like, well, we just sold £1 million worth to your mates down the road, so we can't provide you with what you need. And I mean, I think that's an extraordinary lack of efficiency within our wonderful healthcare system. But yeah, it was an interesting dynamic for a company like Tristel during the pandemic. So anyway, yeah, gold standard of hospital disinfectant in the UK. It occupies most of the market. There is no real growth to be had in the UK anymore unless it expands to new products, which it has done recently. It's launched a new suite of products, which are the surface disinfectant wipes. And they're selling well. They're a tiny fraction of sales at the moment, but that could provide some growth. But the main growth for the company does come from international expansion, and it has done very well to get its products into a lot of international markets. But it is that US market which it just cannot quite crack. And the reason that it wants to so badly is because it's such a big market. The US healthcare market is enormous. It's the biggest in the world. And yeah, being able to have a strong foothold there would be great for the company. So yeah, it'll be interesting to see what Matt Sassoni can do.
Yeah, I was going to ask what the market size was relative to the UK, for example, because it's obviously much bigger, but like how much bigger are we talking?
I don't have the figures, but it's significantly bigger, not only because obviously there are more people, it's a bigger country, but also because of the way the way America is. Like it's 50 countries, and each state does have its own healthcare system, its own hospitals, its own insurance. The way that healthcare works there means that it is just an exceptionally profitable market. I suppose the political situation in the US is potentially a challenge that the company needs to overcome, but I think mainly just getting a foothold there, making sure it's selling slightly more efficiently than it has been doing in the past. It has tried to sell via its own channels. It's tried to sell via partners and distributors. It's just never really got going properly. So yeah, the size of the market is enormous, and crucially, it's that growth that is very important and very needed for investors in this company. So yeah, it'll be interesting to see what happens next year.
Yeah, definitely. I'm assuming there are also some incumbents in the US market as well that they would need to battle against.
There are, but this is the other reason why it's an interesting market, because as far as I'm aware, there isn't one incumbent. It's not like there is a market that there is a company which disinfects all the medical implements in America. There's hundreds of them, and there's hundreds of little brands. And I don't think, because Tristel's chlorine dioxide is patented, it's there aren't other companies using it. So this it is it is apparently the best. Yeah, I think so. Yeah, I think this is maybe more of a story stock than I would like. I as a member of Stockopedia, I think there are reasons to be a little bit wary. The share price trajectory is not good, and I think that is something that being wary of formerly high-flying companies, which Tristel has been, which have come off the boil, is something that I have learned to be far more wary of. Stocks that are going up continue to go up, stocks that are going down continue to go down. And while Tristel share price hasn't performed very well in 2024, it's still not that cheap. Its PE ratio is 23. It's trading on 23 times forecast earnings. Earnings forecasts are pretty much where they were at the start of the year, having gone up for a little while and then come back down again. So while quality still exceptionally high, very high margins, very high returns, very good cash generation, the trends in the share price are maybe a little bit troubling. But yeah, so I would say this is maybe a little bit more of a story stock than I would like, but maybe a story that's going to be a good one in 2025.
I'm assuming that you'd be looking for some good news from the States as a bit more of a buy signal.
The problem is that good news from the States, once there is good news from the States, you'll have missed out on some gains. Oh, maybe the answer is wait for some good news from the States first, and then and then get in. Not 100% sure, but I like it. It's a good company, like high margins. I'm just looking at the stock report. At the stock report, it's one of those situations which we do warn against at Stockopedia. But when individual investors think that they know the entry point, like you can't guess the entry point. But I'm sort of trying to convince myself that I found it right here and now on the 20th of December. But that's not the way to invest. That's silly.
Of course. Graham, shall we come to your final pick for your watch list?
Yeah, sure. So I just wanted to mention Trustpilot. This has been on my watch list for 2 years in a row. In the first year, I believe it generated a return of over 50%. And so far in 2024, it has produced a return of over 100%. And so the time has come to decide if Trustpilot has overheated. This company, I think, probably everyone listening, almost everyone, will be familiar with it. Provides a review service, and it sells subscriptions to businesses to basically help them manage their Trustpilot review. And the reason I find this company so interesting is that I think it has the potential to be a monopoly, because there aren't, as far as I can tell, any meaningful competitors to Trustpilot. Google Reviews is sort of a competitor, but Alphabet or Google hasn't really invested much in that service, as far as I can tell, in Google Reviews, and pretty much anything can and does get a review on Google. And I don't think that there's much work done on the reviews themselves in terms of finding fake reviews, for example. And so when companies promote themselves to customers, not just in the UK, but in many other countries, they often cite their Trustpilot rating. So I think it's an interesting story. I was intrigued by it initially when I noticed that they were making a transition into profitability. So to give you a number, say in the most recent half-year report, they produced an adjusted EBITDA of £10.6 million over the 6 months, and a very small operating profit. However, the market cap is now £1.3 billion. In terms of dollars, it's $1.6 billion. So actually, they do report in dollars. I think it may now be overheated. I said the last time I covered it on Stockopedia's daily report that if the price to sales multiple got to 10 times, then I would have to do something. Maybe I would not be able to stay positive on it at that point. The price to sales multiple is now about 8 times. So it's been a remarkable return. The company has been buying back its own shares. I'm a little bit concerned, actually, that it has continued to buy back its own shares at this level. I mean, I guess from the company's point of view, paying out dividends at this stage may seem like a waste of time because the dividend yield would be very low, and people who own Trustpilot probably aren't in it for the yield. But at the same time, buying back your own shares at this level, I'm not sure if they're really getting any value now at this stage. So this is a bit of a teaser. I guess you'll have to read the article and see what replaced Trustpilot on my watch list.
Absolutely, which will be, we'll try and link that in the episode description. I had a couple of questions. You mentioned you think it's basically has the potential to become a monopoly. Monopolies obviously tend to be characterized by sort of wide, deep moats, I think. Why are Trustpilot's margins so low, and do you think, and how would it go about expanding those?
Well, good question, Lawrence. But I don't think its margins are low in the sense that it's basically an online business, a software business, or a website, however you want to describe it, and it's really just needed to grow a little bit more to cross over into profitability, and future revenue growth should generate, should drop down to the bottom line to a large extent. In terms of where it gets its pricing power and, why do people pay it? I think there's there is a lot of concern out there, perhaps, that the ratings are possibly a little bit unfair on people who don't sign up for the service. That's a view that's out there, that if you don't pay Trustpilot, then you'll end up with more bad reviews than if you do pay Trustpilot. So that is a concern that some businesses have, and maybe some businesses feel it's a bit unfair that they have to pay Trustpilot to basically get more good reviews. Trustpilot would have a different opinion, of course, and that's not how they would describe what they're doing. But the fact that there's so little competition out there means that I think a lot of businesses do reluctantly feel obliged to sign up, and the network effects will continue to grow because they've got 67 million unique monthly users. 300 million reviews on the platform. It's it's kind of bigger than anything else out there. And if Trustpilot is where you go to verify that a business is good, that just means that everybody has to get onto it. The network gets bigger, and it becomes more and more difficult for anyone to compete with it. So I think it has the potential to be a very large business in the future. But I think I may need to take it off my watch list now at a price to sales multiple of 8 times, and maybe put it back on some other year.
You mentioned obviously the main competitor of very few competitors is Alphabet with Google reviews. What do you think the potential is of Google either in basically choosing to invest in its Google reviews and sort of try and eat back some of that, or just buying Trustpilot outright?
This is very difficult to predict, because Google would have to really make a very conscious decision to invest in Google reviews. They would have to create a logo that everybody recognized, that would be a rival to Trustpilot's logo, that would be instantly recognizable. And they would need to get into, dealing with businesses. If they wanted to really charge businesses for Google reviews, make some money out of it, there'd be a lot of investment required. Of course, they could afford to do it, but it would be a whole other strategic direction. It would take years for it to pay off, because it's taken Trustpilot years for their investments to pay off. I don't know if they have the appetite to do that, but it's a risk, I suppose, that you take with a lot of businesses. People say Amazon's going to compete or Google's going to compete. I suppose it's always there that a giant could try to muscle in. But as there is so much recognition for the Trustpilot brand already, I think it would make some sense for Google just to buy Trustpilot. Although then I suppose they'd have to decide what to do with the brand. So short answer, Lawrence, I've no idea, but I guess we'll see.
Megan, it sounds like your kind of company, frankly, high growth tech.
Yeah, it's interesting, Graham, you say that it's maybe time for this one to come off your watch lists. Just turning to profitability, just starting to look more like a high quality operator. Maybe is when a company like this starts ticking some more boxes for me. But I just can't get over the fact that they're buying back shares. That seems like an odd decision. Surely, if there is a market to be conquered and they've got all this cash, invest in it rather than boost up the share price. I don't love that as a strategy. I can see though that there is. I can't think of any other review companies other than Google, as you say. So it certainly
I occasionally get emails. We use Trustpilot at work, and I occasionally get emails from people purporting to be competitors or sort of alternatives to Trustpilot. But again, like the Trustpilot brand is so strong and sticky that, and I'm quite busy anyway, but I just never give them the time of day. I never even look past the email.
Yeah, absolutely. And so I think that is that obviously then feeds the network effect, as you were saying, Graham. But companies like this that have taken a fairly long time to be profitable also ring slight alarm bells for me. Like, why is it only achieving operating margins of, well, it's just under 2% in 2020? Well, the financial year just gone, which I assume was the financial year to December 23. And so I assume those operating margins are now higher. But I feel like it's taken slightly too long to become profitable, and the share buyback thing. So Graham, I'm with you. Actually, in as an all-round conclusion, I think maybe the growth has might taper out a little bit as the company settles into a slightly different type of investment, I guess. It's been a fast growing on the revenue level, and it's obviously not going to be able to maintain quite such a pace of revenue growth. And as it settles into a different style of investment, it might start appealing to a different nature of investor, but isn't quite high enough quality yet for those.
And on that note, we've had a bit of a bumper episode, a little bit longer than our normal ones. So I think we're going to wrap that up there. I hope you've enjoyed that. If you are a subscriber to Stockopedia, you will be able to access the full watch list on the platform. If you are not yet a subscriber, you can head to stockopedia.com and you can enjoy our free trial and enjoy all the content, all the insights, all the tools available on the platform, free for 2 weeks. Thank you very much for listening. If you've not done so already, love it if you would go and leave us a rating on your podcast platform of choice. And if you know of anyone who you think would benefit from listening to this, please share the episode with them. Thank you very much, Megan. Thank you, Graham.
Thank you,
Thank
Lawrence.
you.
And Happy New Year, everyone. We will be back next week, same time, same day, to run through the first full week of headlines for 2025 back in our normal format. So we'll see you then.